good morning. Thank you for being here, part of this session. We're going to talk about money. We're going to talk about fundraising, investment capital, things of that nature. We're going to spend about 5 minutes kind of talking about the market as we see it right now from kind of a research and analytical point of view. And then we're going to spend the majority of the time here having a conversation with this awesome mix of entrepreneurs and investors who have agreed to join us today. And thank you guys for being here. So we'll get to the intros here in just a second. So my name is Jeff Pesic. I'm co-founder of Tech.mn. Mike Bollinger is also co-founder of Tech.mn. So slide deck.
Yeah. So Tech.mn is the source for what's happening in Minnesota technology news. And as many of you guys know, we launched in January of 2010, so it's been a little over 2 years now, and it's been a really fun project just to really increase the awareness about what's happening in Minnesota technology and increase the connections among and between guys that are sitting up here, investors and entrepreneurs. And this panel is really part of a series that we've been doing every year at MinneBar on some sort of topic related to fundraising in Minnesota, and it's been fun to watch Minnesota evolve even over the last 2 years, and we're going to talk a little bit about that today.
We're not alone. Mike and I are supported by a phenomenal team. This is about half the people that work with us as contributors, creators of content, assistants, researchers, whatever, you name it. And if anybody in this audience has an interest in working with us, we're always open to bringing people in and adding more value to what Tech.mn can do for the community. So just want to give a shout out to those who have helped us to this point and those who continue to support Tech.mn. Thank you. We also have a program called Bridge.mn.
Yeah, I was just going to say real quick, for those of you who don't know, we do have a program called Bridge.mn, and this is a program that we started in partnership with the Project for Pride in Living, and this program is all about giving back to the community and supporting the youth in our community, because really they're the future of everything we do, right? Without them, we're kind of screwed in the future. So this program, we help give youth who are underprivileged laptops and internet access and training in technology to really help inspire them to get into the science and technology fields. We're always looking for donors and companies that are willing to help support this cause.
Yeah, I was going to say, we've raised $21,000 so far, and as soon as we get our heads above water, we're going to come and ask every single one of you to help us raise money to get these kids computers. I mean, could you imagine not having a computer? Seriously.
Yeah, and we expect $21,000 from each of you. So over $60 million was raised in 2010 that we track investments on a quarterly basis since we started doing this in 2010, and we've really seen that number grow. Partially, that number has grown because there's more awareness about who's doing what on the ground here, but partially that number has grown because there's more activity here in Minnesota as well.
Yeah, there's a lot of reasons for that, but so we didn't really break things down super detailed in 2010. It wasn't until this year that we really got into all the granular data, but for the purpose and the context of this conversation and what Tech.mn is concerned with, IT, software, web, mobile, digital media, hardware, telecom, generally that aspect of technology. So we're not talking about clean tech, green tech. We're not talking about medical device or life sciences. So this is a sliver of the technology umbrella for the context of this conversation. We saw in 2011 things really started to pick up a little bit. So we started breaking fundraising reports down on a quarterly basis. And then we saw first quarter, 20 startups were funded. Second quarter, 19 startups. Or ventures, if you want to call them that. Startup is kind of a nebulous term. Company, startup, emerging company, the growth companies essentially. Some are later stage, could be a D round. Some are seed stage, could be $25,000. So there's a lot of range here, and there's a lot of ways to interpret the words and the terminologies and the data. And this certainly isn't perfect, because there's deals that happen and transactions that we all know that are unreported or off the record for whatever reason. They don't ever, get disclosed. And we're aware of some of those as well. So I know that these numbers are higher, but this is really what's like out there publicly being talked about or is somehow available through original research.
One of the really exciting things that happened from 2010 to 2011 is that we did see a lot more money being raised, and then even this year in 2012 thus far, we've seen a large amount of money being raised, helped very much by the enormous raise by Code 42 of $52 million in the first quarter of this year.
Yeah, so you see a lot happening there in 2011 last year. So, how many companies were funded in this quarter, first quarter of this year? 24 companies have raised $59 million, maybe. 23 companies raised $6.5 million, right? Love Code 42, but let's be honest, they're a little later stage, and we have to count that, but we're really looking at the fact that there's only 23 companies that raised $6.5 million. So, slow start for this year, in comparison to what we've seen in the past quarters. So, just an idea to compare the number of companies with the cumulative amount of funding on a quarterly basis going back 1 year. This is what it would look like visually with a 100 million scale. That's the reality at the last quarter there for the first quarter of this year. It's not final. There's still some more data out there that we're looking at and still collecting, but that's roughly where it's at as of today. So January, February, March 2012, that's where it stands.
So let's go ahead and introduce you to the panel here. We've got an awesome lineup, a bunch of entrepreneurs, a bunch of investors. These guys are smart, and they've been there, and they're doing real things right now. So we'll just go down the line here and let these guys introduce themselves. We'll start here with Darren.
Hi, I'm Darren Cox. I'm the founder and CEO of CAST. We help universities, national labs, and research hospitals and big corporations market and license their intellectual property.
Hi, I'm Tony Abena. I'm an angel investor. Was a founder, an investor, and a board member at Jobs to Web. We just had a good exit there in 2011. I'm on the board of Jingit right now, and I'm an investor in that company. And basically, I've been sort of angel investing for the past 5 or 6 years. I like to invest in good teams and good technology.
Good morning. I'm Jim Moar. I'm the CEO at Optimine Software. We solve complex pricing problem that exists in every online advertising channel. We'd like to think we do it better than anybody else, and I think we've got the track record to prove it. We had the good fortune to raise $3.6 million last year with Hummer Windblad Venture Partners as the lead.
My name is Kopischke, and I am a co-founder of Invenshure. It's a technology incubator with a venture fund attached. I would consider myself an entrepreneur, but we also do venture funding as well. We currently have launched 2 companies. One is called InBio, and it is in the medical imaging space. And the other one that we've launched is Exosite. It's a cloud computing platform for the wireless and sensor world.
Morning, Justin Kaufenberg, CEO of TST Media. TST Media is a sports-specific software company. We have a single product. We call it Engine. The Engine platform is used by sports organizations, sports leagues to manage their data, statistics, standings, information. We've raised some family and friends money over the years, an angel round, and most recently about a $3.5 million B round about 6 months ago.
Good morning. My name is Michael Gorman. I'm with Split Rock Partners. We're a venture firm with an office and headquarters here in the Twin Cities as well as in Silicon Valley. Most recently, we were part of the Code 42 investment. We're excited about that as well as all the other stuff that's going on here in the Twin Cities. This is a core part of our business. We've invested over time over several $100 million in Minnesota emerging technology companies. We invest both in software and internet services where I focus as well as medical devices. Happy to be here this morning. Thanks.
Thank you all for being here. So quick mention, this is a panel discussion. It's open. You can raise your hand. We'll come find you. You can send a tweet at tech.mn with a question, or you can text us a question right now as we're going through this stuff. So we'll be taking in those 3 ways. And what we really want to do is provide a forum for those who are interested in talking with people who are doing it, the best opportunity to do so. So if anyone has any specific questions right now, raise your hand. Otherwise, we're just going to start a conversation based on how we want to take it. Go ahead.
So looking at that chart, excuse me. Looking at the chart that visually depicted, the quarterly fundraising. So quarter 1, 2012, are we seeing a decrease in funds raised because it's a lack of idea, or it's attributed to the economy right now, or what? Why is that significantly decreased?
I think he's light by about $20 million. I mean, based on what I know about what's going on here, there's 4 or 5 deals that aren't up there. So I think it's actually on a par with last quarter. I mean, there's a lot of stuff going on right now.
Sure are, but then you would look at the last quarter and say, same thing for the last quarter. There's
Yeah.
other deals there, so those numbers.
But I think there's actually the deals that I'm aware of. There are a lot. It seems like there's just more stealth going on this quarter. There's a lot more stuff where it's social or it's something where it's just not out there. I don't know. That's my impression.
When I saw that, I have one comment. We have a bunch of funds that are actually, for our startups, that are actually stuck in escrow right now for the Minnesota Angel Tax Program. So I think there's a Minnesota Angel Tax Program that's delaying this quarter. You're going to see money shifting that we have multiple millions in the hopper that I can't access yet regarding. Just waiting for the period, 30 days time frame for Minnesota Angel Tax Credit to click, and then we'll move that money from escrow into the actual startups themselves.
Yeah, to play off of what Troy said, we actually had to wait until the calendar changed to 2012 to take in some money from one of our investors because they had reached their tax credit limit for last year. So write your legislators and tell them to up the angel tax credit. And I know there's some work being done on that, and there's an email sent out this week. So.
Question here.
Good morning. How long has it taken you to complete the funding that you've recently accomplished, and kind of what are you seeing? Is it 6 months, 18 months, somewhere in between? And kind of some of the key milestones to getting these things done?
Sure, I can start. The most recent funding that we did ended up taking about 4 months from beginning to end. But, take that with a grain of salt because we felt like we were fairly prepared when we went out. Had spent a lot of time kind of relationship building up to that point, had spent a lot of time with, just deck preparation, kind of business preparation, and just positioning the company accordingly. So when we went out, we were able to be, pretty effective in those 4 months and come to conclusion. But there's a lot of preparation prior to that.
We had a similar experience. It was about 5 months from first VC visit to close. I would second Justin's comment about being prepared. I would also further say that use those first VC presentations as fast learning. I would say that every presentation we made, we came away with a better idea about how to present, and that helps it make it go faster.
So we're just about to go out and raise another round. Our first round took a long time. It took probably 9 months from the first discussions we had with anyone to the time that we were done raising money. We certainly learned a lot in that period. I echo what everyone else said. Be prepared, especially your financial model. Be prepared to answer questions, something that I was definitely not and I'm still terrible at. Like I said, we're getting ready to raise another round. I had one of our investors in our office yesterday for about 3 hours helping me prepare to go out and do investor pitches for the next round and really just sort of making sure that we can answer all the tough financial questions.
Question for the investors on the panel. To what extent are you guys proactively looking for deals or reactively looking for deals? Do the entrepreneurs come to you, or are you and you're overwhelmed by the number of requests, or do you actually go out and proactively look for them?
I'd say it's absolutely a mix. I mean, we see as a part of our job to have a combination of a prepared mind for an opportunity that, if it comes to us through whatever source, fellow entrepreneurs, other CEOs with whom we've worked, or other relationships with that we have for the firm, that when we see it, hopefully we can recognize it as this is in a category or a type of investment or a type of team that we want to spend some time with and explore. In addition, we do just some of our own background work, like everybody here, trying to get a sense for what are some megatrends that are at work and how will those manifest themselves in disruptive business opportunities that hopefully some people in this room and elsewhere are figuring out a way to exploit and then pursue. So when we see those and when we see people working on those things, we will try to engage in that as well. So it is a mix. That's our job, to be both responsive but with a prepared mind, and then proactively looking for things. So it is a mix.
Yeah, I think, as an angel investor, I probably on an annual basis probably see somewhere between 100 or 200 opportunities. I tend to try to stay focused in the Midwest, but sometimes something really interesting comes across the transom from the West Coast, although that's generally, there's more sort of people chasing deals and deals out there, I think. But so it's a mix, but I think referrals, the best means for me is folks that I know, and then getting referred into those situations and then syndicating if that makes sense. But I think the number of deals for me in the last sort of 12 months has increased a lot. I think the tax credit has something to do with that, but also I just think the general macroeconomy, there's just a lot more people I think that are out there either trying to make their own opportunities versus going back into the job market, or folks that are just kind of sick of working for the man, doing something different. And that point that I think Michael was making about is sort of this artificial weird distinction between is it the market that's more important to the people? And I think maybe both of us would say it's great when those intersect. You have great teams and great opportunities kind of coming together, and that's what I look for. And I've seen a lot of really interesting stuff. But somebody asked me out before I walked in the room, how many deals do you invest in? How many deals does it take before you invest in one? I think right now my ratio is probably 20 to 1. So I look at probably 20 things, and of those, one of them is sort of investable from my perspective.
Question here. What is, I'd like the investor's view on what crowdfunding is going to do to your strategies?
Too early to tell is the way I would honestly answer that question. I think anybody who cares about entrepreneurship and the development and advancement of innovative technologies applauds any form of new means by which early stage concepts can go from idea to development to launch. So my hope is that crowdfunding works in a manner that serves that objective. And by that I say it's still too early to tell whether that mechanism is going to be effective from an efficiency standpoint for the entrepreneurs, et cetera, to get there. But I think anything that creates more opportunities for entrepreneurs to get funded is terrific. One of the challenges historically that for an early stage company is making that jump from initial friends and family to angel to venture. And I think a part of the objective of crowdfunding is to help bridge that gap, and perhaps Tony can speak to this, and as well as the gentleman from Invenshure, about how that plays into that continuum. But overall, I think all of us are looking for as many ways as possible for these companies to get started and going.
I'm very supportive of the crowdfunding. I was contacting legislatures to push it through, primarily for many folks, young folks out there, as initial seed funding to get out there. And we did look at it. I guess one concern I have is we raise money from a large angel pool. Our fund is really a group of angels that we look to invest in, and I manage about 45 angel investors' expectations, which is a lot. I mean, it's a lot. There's a ton of trust there in those 45, so I don't spend a lot of time there. But my business partner and I were brainstorming about this crowdfunding and whether or not we could do it. And we're thinking, well, let's go out and grab 1,000 people, right? And then start managing 1,000 people's expectations at $5,000 a pop. I just can't even believe that. You would have to hire 3 or 4 full-time people just to manage that communication channel without really properly managing it, because you are taking people's money, and then And when you take people's money, you should treat the money as more important than your money. So I'm concerned about the amount of interfacing that would have to happen with that quantity of people. I think my job at 45 is
Troy.
tough.
Troy, what is it? Is that money a donation or a taxable income event?
You know, I actually got a brief from recently on this describing it, and the brief was written from a New York law firm. So you needed to be a lawyer to actually read it. I read a lot of those documents, and I think there's still some unclear components of the crowdfunding and how it actually works. And I'm excited about it, and I'm supportive because I really think there's a need for that seed funding. You just have to be careful on the expectations and how you manage that. We manage by sending out quarterly reports, but even quarterly reports raise a bunch of questions, and then you get phone calls, and I can't imagine getting phone calls from 600 people on what we're working on. So.
Okay, moving on. I have a question here.
Jeff, do you mind just one follow-up to that? I think a number of folks probably saw that the Jobs Act was just signed literally this past week. This is a pretty meaningful piece of legislation for emerging companies, and it speaks a little bit to there's a crowdfunding component to it, but more generally, it expands the number of investors that can be in a company prior to it becoming a registered company. So previously, you could only have 500 shareholders before the SEC required you to become effectively a public company, to register with the government and provide all sorts of information. That number's now been expanded. Is it 1,000?
Oh, it's 1,000.
It's now 1,000. That's a really meaningful difference because a lot of individual or angel-funded companies over time started bumping up against that as they raised substantial amounts of capital. So just good news is there actually has been something that's come out of Washington that has helped the entrepreneurial community. Still too early to tell exactly how much, but that's another contributing factor to hopefully a better early stage funding environment.
Really quick, Jeff. If you're an entrepreneur or an investor, these are the kinds of things that you have to pay attention to.
Question for the investors that seems to be quite popular right now is what are you excited about? What are you bullish on moving forward here? What's hot in your eyes for the investors?
You know, from my perspective, that's a really difficult question to answer because I see so many different things, and I don't know. I must be very ADD or getting more ADD in my life because I'll be thinking to myself, wow, XYZ is really interesting. Then something will come across the transom. I'm like, wow, this is interesting. And so, personally, I think I'm not an investor in med tech much or clean tech or things like that. I mean, most of my experience has been taking kind of old world sort of process, to the web and doing something interesting with that. Certainly, Jobs to Web was like that back in the day when I was at Techies. That was what was going on. But I generally am pretty open to sort of what's sort of out there, and I generally kind of again look for that intersection of a great team and a great opportunity with some pretty good upside in the market. So I don't have a specific domain. I guess it's got to be something that's powered by technology and something I feel like I can understand. I guess that's my biggest criteria. Is that most of the time when I'm in these meetings, sometimes I just can't even understand what it is, and it takes me a little while to sort of get there. But it's that intersection between the tech and the team.
Did you want to answer?
Yeah, I'll just. Please. We focus in the scientific technology area. Our incubator is we're really excited about different technologies that are in universities. So we've developed different university relationships and grabbing technologies that are that I think can really help mankind. A lot of the stuff we look at is in the medical diagnostic imaging space, but they're inventions that need to be fostered and brought out. Our model is pretty unique. We look at things that are really, really early stage and then try to get them through to commercialization.
I guess just a couple of thoughts. In some ways along the lines of what Tony said, we look as much for attributes as we look for a specific domain. So all the areas where you are all working, cloud computing, the disruption that represents for applications all the way from the consumer all the way through the enterprise is something we continue to see accelerating. That's the manifestation of that inside enterprise accounts or enterprise companies is dramatic and is now accelerating. And Code 42 is a great example of that. A company that plays in a freemium model, a compelling consumer experience that then morphs into and expands into an enterprise play with the leading, most sophisticated tech companies and enterprises. That type of thing is super exciting for us. Big data and analytics. I mean, if you look at what both Jim and Justin have been doing, Jim's playing an Optimine, really hardcore analytics, differentiated product, super smart founding team and great business judgment combined with Jim. Those are trends that a lot of people in the investment world are trying to figure out what's a differentiated means by which to make sense of all the information and make it actionable and useful. In Justin's case, you've got a company that has a specialized focus in an area where they've developed a compelling platform at a compelling price point. Part of what is so interesting to us about this era is the development costs for everything have come down so dramatically from from even 10 years ago, 5 years ago, with open source tools and all the stuff you guys use on a day-to-day basis. The result of that from an investor standpoint is we're looking for evidence of actual user adoption and traction, because we presume that anything anybody builds can be built by somebody else with a sufficient amount of time, and there's a lot of smart engineers in the world. We're fortunate to have a ton of them in this room and in this business and in this region, but there's a lot of smart developers who with 6 months and serious dedication can do amazing things. So what we're looking for is evidence that a company is taking advantage of those trends but isn't in any way complacent, because somebody is going to be going after that same space if you've demonstrated any traction. So we're trying to determine, is there a combination of an opportunity that's compelling and a company that has the potential to actually be a leader in that category. And one of the pieces of evidence we're looking for is true user adoption and traction. And in both of their companies' cases, they've shown evidence of top-flight growth, top-flight user adoption, and growth metrics that say it's not just that we've got a great app, it's that people are using it. So I think it's a part of the dynamic from a funding standpoint, at least when you get to a venture funding level, people are looking for, in light of the low cost of development, has that then translated into a compelling experience that's reflected in user growth and acceleration? So those are some of the attributes we're looking for in addition to what the other gentleman said.
Okay. So I have kind of a nuts and bolts question for folks who are going to go in the marketplace for investors for the first time. Do you have any advice for thinking strategically about the continuum of investors, the friends and family, and along to the various rounds, and thinking about how to strategically decide how much equity to give away and at what price points? Easy question, right?
Yeah. I'll take a quick stab at it because we've been kind of through a somewhat similar continuum over time. You know, the answer for us at least was that we'll deal with the next step when we get to the next step. Because at least to a degree, when we started, pretty humble beginnings. It was nothing, a couple of guys, and we didn't have a dime. So if we could, entice friends and family to give us a few $1,000s to get us going and to get our first prototype to market, while we didn't want to be, inappropriate with the way we structured that, on the same token, we did it on a Word document for, $100 half an hour legal fee to make sure we didn't completely screw it up. I'm not advocating for that being the case, but early on, we were so bootstrapped that it was simply a question of, let's try to be smart, let's try to be strategic, but ultimately, you can be strategic all day and never cash a check and not get anywhere. So at least for us, we had to have, a little bit of expectation setting early on just to get off the ground. When we got to our second stage and we got to more of an angel round, there we got to think a little bit more strategically. There, locally here, we worked with the Twin Cities Angels, with a number of individual angels. We got to find some really smart people with smart money who knew the space, who were able to add value on our board. That was probably the most important thing to us. Less about even the structure of the cap table, so to speak, necessarily, because you can argue all day about valuation. More about finding people who are supportive of you at that moment, but then also supportive of us and our objectives to raise another round and to get dramatically larger quickly. So for us, it was less about, I think less about the actual physical valuation detail cap table. While we needed to be legally accurate, we needed to find good people first and foremost that were willing to get behind us.
One of the things that's so fascinating about startup emerging space is the rules don't really exist. And so I always go back to kind of basic principles. Principles are going to be different from one person to the next, one company to the next. I think what Troy said earlier, which is treating every investor's money like it's your money, I think is absolutely critical. I think you really, as much as you can, look to the next step, knowing that you're going to probably be wrong, but at least you've thought it through. Third, kind of do some triangulation. I mean, even as we went through the VC round last year, there are no exact rules about how to do valuation. And so but if you can triangulate in some sense, sometimes it's only 2 things you can do rather than 3, but that's better than 1, to try and say, does it make sense to you? I think all those things can be helpful.
Just one thing to add, I think from a nuts and bolts standpoint, if you're doing the very first round of friends and family capital, I'd encourage you to not sell control of your company at that point.
Absolutely.
Yeah. Again, I don't mean to be patronizing by the comment at all. I just think that it's something at that stage it would be premature to find yourself in that. And it's at the same time, down the road, entrepreneurs who are solely focused on control typically limit their opportunity down the road in terms of raising sufficient capital to actually fuel the business. So, but at the very, very first stage, I would not have that as as an objective that I'm going to take as much money as I can, even if it means losing control of the business. Justin, when he built his business, did it slowly, profitably for a while until he really found the model that he wanted to pursue, and then he started putting his foot on the gas and raised more capital to do it. The other so I think that element is just something to keep in mind. The other element I'd ask you to think about is the size of the round that you're raising. So one of the questions for an investor is, where does my money get this company? So what we're looking for is clarity that this pool of capital is going to add material value to the business so that when it needs capital the next round, you've made enough progress. So if you think, okay, well, we're raising our first $300,000, that's going to get us to a launch with these sets of customers, and as a result of that, we will be able to raise capital at a higher price because we'll have met some of the risk reduction thresholds that investors will be willing to pay me for. I'll have added to my team, I'll have some customers, I'll have a live product, whatever it may be. Those are really meaningful for you to think through and be able to articulate to an investor. Not just that I don't want to sell control and I think I need $200,000, but this $250,000 is going to get us here, at which point we're going to go raise some more capital, and we think we'll be doing it at a materially higher price. So scaling the round appropriately for the moment of the company's development is really important, and you should talk to a number of different advisors and fellow entrepreneurs and make sure that you stress tested that, because that's an important question as you do the nuts and bolts plan.
I think I'll try to answer it kind of specifically based on my experience. The angel round, typically I'm going to probably want somewhere between 5 and 20% of the company, depending on a number of factors. So it just depends. But his point about sort of not selling too much is really important, and thinking through the logic of each of the rounds. There's a logic and an appropriateness to each stage of the round, whether it's friends and family to angel to A to B. Each one of those has a set of milestones and things you want to try to achieve in those rounds, and being really thoughtful about what that means is important. But from my perspective, whether it's convertible debt with a cap or priced equity or whatever we're going to do in terms of structure, and people generally a little too hung up about structure. I mean, Michael's point too, which is, hey, it's about the company and the quality of the company and the quality of how you're going to make it something real and enduring is more important than the other stuff. You can work through that. But generally, my deal structure typically prefer just sort of a convertible debt with a cap or some kind of a discount, or we kind of work through that stuff. But really, it's about where are you trying to get to, what's the opportunity, and how are we going to get there. But that's 5 to 20 is sort of where I end up, depending on that. And do not sell control of the company too early. Absolutely.
Just real quick, I think I agree with what Justin said. I think there's an important point of always staying frugal until you get that, until you see the light and things start to take off. There's some great curves. The books out there now are fantastic for all of us. The first company I did, we launched a company on 10 grand and kind of cash flowed it from there. And I remember sitting on metal chairs, and I brought my pillow in from work because my rear end hurt. But you have to stay frugal, and it's important. And there's a book, Lean Startup, Venture Funds or Venture Deals by Eric Reeves. those are great books for digging in to kind of guide you through that process. It's a fantastic book that I didn't have, when we were starting.
Thank you. Lots of questions coming in here. I want to keep this thing moving as best we can. For the investors, I'm going to fold two into one here. First of all, of your portfolio companies, which are you most bullish on? Just name one that you like and why, okay? Second question would be, what are some early stage value inflection points or milestones that you look at to identify opportunity when it's not clear? It's not like some massive revenue trajectory, but there is value that's being created. What do you look at in that sense? Michael?
That's a quick question?
Yes.
Okay.
The first one at a time. Go.
All right, so I have to pick amongst my children.
Yes.
Thank you very much. Appreciate
Yes.
that. So, all right, for ease of and most recency, I'll say Code 42, I'm excited about the business. They're doing great. Huge opportunity. What was the second part of the question?
Value inflection points, early stage. What do you look at?
What's the evidence the company is in a position to be a leader in its category? And that differs by company, differs by category. But is there a real shot that this company is one of the one or two or three businesses that define that space?
I really like TST Media.
I'll answer it more globally. I think both of the portfolio companies that we launch are cloud computing, and we're looking at plugging in disruptive technologies into kind of a canned platform to really change the business market and be one of the top 3 leaders in that space.
I think the going out and riding along with reps or early on with founders and seeing just absolutely stunned customers when you get that feeling like, my God, I can change the way I do business. I've seen that in 2 or 3 cases where I'm spending $10 million, now I can spend $1 million. There's a huge ROI, a huge game-changing opportunity. When you see that and you close deals in a pretty fast way, the jobs to web thing, starting out with really only about $5 million invested in that company, sold it to SuccessFactors for $110 million. The pivot we made to sort of move the company from where it was early on to sort of where it was, but to watch customers Microsoft, all the customers we had just to immediately sort of get it, and the sales cycles compressing massively from we thought early on 6 to 9 months to 1 or 2 months in some cases. I look for that. When a customer sort of gets it and they see it and they're just really excited about it, to me that makes all the difference in the world.
And Tony, what current investment are you most excited about?
Well, I'm on the board of an investor in Jingit, which is kind of a marketing engagement platform. We're just out there. We just can't say too much about it, but we just are on the verge now of that significant customer traction. We've got a number of closed deals this quarter. So I'm pretty excited about that deal. I'm also excited about a little company out in California called Gwabit, which does some stuff with email. But there's a couple other ones, but those.
Okay, he got to talk about more than one company, so I got to at least. So Eighth Bridge is a company a number of you know. You probably know the kind of phase 1 of what Eighth Bridge has done. Next week or 2 weeks, there's going to be a major new release and launch. Jamie's here. It's really, really exciting stuff. That company is absolutely leading what's going to take place in social commerce. The brands and the folks with whom they are working and the partnership that's at work with is really exciting stuff. So I'd encourage you guys, particularly in this community, you guys know a lot of the folks, including Jamie. Check it out. They're doing some great stuff.
What advice do you have for entrepreneurs who are getting ready to put themselves in front of investors, but they've never done that before?
Practice.
Well, no, practice. The best advice that I can give is talk to other entrepreneurs who've already done it. Talk to Justin, talk to Jim, talk to investors who have been entrepreneurs. I mean, sometimes, and this is to take nothing away from any of my investors, but sometimes it's harder to talk to folks who haven't started a company the way that you're about to, who haven't put their kids' college fund and their 401k and everything into something. So talk to Leaf, talk to Justin, talk to me, there's a whole group of people talk to Jamie. There's a whole group of people in this room that you can talk to and just do your pitch for them. They'll ask you way harder questions than some of the investors will. And also, by far, get ready for the financial questions. It's the thing that I'm the worst at, and it's the thing that I spend the most time trying to get better at.
I'll tell you from our end what we did, and I sat in those seats a few years ago, and I didn't have a clue. I came to funding panels like this, and people would say, well, be careful, with how the cap table dilutes, and a convertible note, with a cap or a 20% discount. I sat there and nodded my head, so I looked smart. I didn't know what the hell they were talking about. So I can sympathize with a lot of people out there who are thinking about doing this for the first time. A lot of buzzwords get thrown around, and it's hard to, well, A, admit you don't know what they mean, but then B, actually figure out what they do mean. So at least for me, the way I prepared for growing the company in general was just immersing myself from an education standpoint. I read everything I could get my hands on, and I discovered all these great bloggers. People are so transparent with their information these days. Spend $2.99 on Chris Dixon's Kindle book, which is just 100 of his blog posts organized into a simple Kindle book. It is the how to start a company, raise money, do your angel round. He's got example term sheets up there. So many of these now household name venture capitalists have really been forthcoming with what they've dealt with over the years. So to me, at least, the total difference maker was being able to have a meaningful discussion with investors because I had just immersed myself in the industry and become an expert.
A couple thoughts. I mean, I think the comments about practice is absolutely right. Don't be afraid to learn fast from doing it the first couple times. All of these things about the financials and cap tables, it's important, but it's the mechanics. The critical element is what you do in the first 5 minutes. It is about having a compelling story. Michael talks about articulating in a way that you can present yourself as you are going to be a leader in your space. I think that's what a professional investor wants to hear, that you're in a hot, growing space and you have a clear, powerful, compelling value proposition. And that last piece is really hard. Working on Mesa, we're emerging software advisory here in town. We work with emerging companies, and working on that value proposition and being able to articulate it well is one of the hardest things for entrepreneurs to do, but it's what the investor needs to hear.
All right, thank you guys. Last question here, one last question.
This is really for Michael and for Tony. One of the trends I'm seeing is that some maybe founders and angels are trying to fund deals themselves and not get the VCs involved. I'd just like to hear your thoughts on, for example, Tony, if you fund an early stage deal, do you want to keep that deal in your group and maybe stick with angels all the way through exit? Michael, are you okay with a company that has 100 shareholders? It seems like companies seem to be on the VC track or the angel track. I'd just like to hear what your response to that would be.
I don't know about, I like the and versus the or. I mean, I'm not a bigot about angel funding versus VC funding. Each participant in the equation adds value to the equation. I like investing alongside. I've done deals where I invested alongside VCs sometimes, and we've worked together on kind of the terms and how it's going to work. And I just don't have a problem with that. I think angels fulfill a very specific function, kind of between that friends and family and when you're really going to sort of scale the opportunity, and VCs are going to be able to provide generally a lot more fuel to kind of go forward with. Keeping, like Troy said, keeping all the angels sort of managed and kind of aligned in the same way is not an easy thing either. So I like it. I'm fine. I'm fine. Like I said, every round has a function and a very specific purpose, and going to that A round or even a B with VCs makes a hell of a lot of sense sometimes. I mean, sometimes to the point where you don't need a lot of capital and some companies can fire up without it. That's great. But I think there's a role for all of us to play here, and I think it's fine to work very closely with VCs when it's required.
I know we're short of time. Completely agree with what Tony said. What we care about is companies that win. We want to figure out what's the complexion of ingredients around the table, part of which is our capital and hopefully some of our experience. But there's a lot of talent, both in independent board members and angel investors. We want to assemble the team that's on the field to win. So if that's an angel VC combination, great. We fundamentally, our objective is to put capital to work, help companies grow, and through that process make good returns for our investors. There are a lot of good questions in this audience. One thing I'd encourage for the entrepreneurs is to start with good counsel. Doug Ramler asked that question. I see John Roberts is here. I know Jeff Robbins is here. There's a whole bunch of really good attorneys in town, and I can list them and share with them afterwards. But all of the folks who really focus on this sector really can add a lot of value to an entrepreneur who's trying to raise some capital and walk through that acronym jungle that Justin just described, and what a term sheet looks like, and it really help you navigate that. So encourage you to really start with quality counsel as one of the first big decisions you make as a business.
Awesome. Let's give a round of applause to our great panelists. Thank you very much for being here. Thanks, panelists, and thanks everybody in the audience. Have a great day.